This is a recording of the Chapter 9 exercises, and we'll do quite a few. This is exercise 9-1, just coming right from your book, and it's off a little bit by page numbers. In your book, it's actually page 478, in ebook, it's 479. So right here is January 1, Manuel Company's merchandise inventory was 300,000. During 17, they purchased 1,900,000 of merchandise and recorded sales of 2 million, and the gross profit was 20% of the selling price. So the question is, what is their merchandise inventory at December 31 of 17? We'll kind of have to back up the train to get there. And a key thing right here will be this gross profit margin at 20%. So I just got this T account set up in Excel, and we'll just plug in what we know. And what they gave us was the beginning balance of 300,000. Okay, that's what we start with. I'll make this a little bit bigger. Okay, so $300,000 to start. And then we have to figure out what the ending number was. They also told us that purchases were 1,000,009. And then we had to compute what the ending balance was right here. So that's kind of the mystery. And then what we have to do is figure out what cost of goods sold was. So they told us that they had sales of 200,000. So down here, I'm just going to plug in a sales number of 200,000. And then to compute that, they said that the gross profit margin was 20%. So I'm going to take in this next cell, go +1 minus the gross profit margin of 0.8. And I'm just going to take up here, multiply these two numbers by each other. So sales times 1 minus gross profit. And that gets me 100, and actually it should be 2 million. There we go. And then this gets me to 1,000,006. So then we can all easily figure out what the ending balance was. So I take my beginning number plus the 1,000,009. That was my cost of goods available for sale. The 300 plus the 1,000,009. I subtract my cost of goods sold, and that gets me my ending balance of 600,000. So that's how you do that one. So, but the key here, the one that maybe wasn't quite as obvious, sales of 2 million. My cost of goods sold is 20%, or my gross profit margin is 20%. So my cost of goods sold is 80%. So 2 million times 1 minus 0.2, I get 1,000,006 as my ending balance. Okay, so that was question 1. Let's go back to the ebook and look at question 2. This one is a little bit simpler. It's just more of a concept question. And it says here that distinguish between period and product costs. Sperry New Holland manufactures farm machinery. During 17, it incurred a variety of costs. Explain several of which appear in the list. And then at the bottom, they want us to classify each as a product cost or a period cost. And for costs that are probably allocable to both, suggest a reasonable allocation approach. So let's go step by step and kind of go through them. And this would be better in the classroom. You guys can tell me what the answers are. But the first one is letter A, comprehensive liability insurance premiums on the corporate headquarters. And the key here was that was for the corporate HQ. And because of that, that'd be a period cost. Basically, just anything that involves kind of more corporate would be a period cost, expensed as incurred. Letter B, depreciation on production equipment. Hopefully, you're realizing the word production there means something. So because this is depreciation on equipment used to make the products, farm machinery, that it would be a product cost. And if it's a product cost, all of that depreciation goes through work in process and becomes a part of the cost of the finished good that we manufacture, and turns into expense when we sell the finished good to whoever we sell it to. Electricity consumed. Now, this is a very general statement because they didn't tell us, is this electricity on the manufacturing side or on the corporate home office side? They don't know. So because of that, the answer is both. Now, could we allocate this? Absolutely. Do we need to? Maybe. That's the question. If a lot of electricity is consumed in the process of manufacturing heavy farm machinery, and I would guess that's probably the case, then we should keep track of electricity consumed for our manufacturing side versus the home office side. And most likely, the electric company would have a separate meter for both, I would dare guess. But that would be, one thing to think through is most likely there's a separate electric bill and electric meter for the HQ, the headquarters, versus the production facility. I would dare guess that's the case. So that wouldn't require an allocation then, because I'd have the separate bill. Property and casualty insurance premiums. And again, they didn't really say, well, is this insurance premium on the home office building? Is it on the factory and the machinery in it? What is it for? We don't know. So the answer has to be both. Because it's both, we need to think through how can we allocate that. And in reality, you could most likely ask your insurance company to give you a separate bill for separate facilities. Now, if your home office is connected to your manufacturing facility, that may not be as easy for the insurance company to do. But if that's the case, what you could do is try to come up with what's the value of home office type building and equipment versus what's the value of production facility and machinery to make our product. And you could allocate maybe just based on the value of the items that you're insuring. That'd probably be what I would go for if I couldn't get the insurance company to separate the bill for me. Raw material used, letter E. Hopefully everybody knows that's pretty easy one. It's just product cost, right? That's your whatever the raw material is used to produce farm machinery. So if it's steel, iron, aluminum, whatever that would be, would go into that. Letter F, royalties paid to the designer of one of the company's products. We bought a patent, we bought the plans to build something from somebody who designed it. We're licensing that, and from that perspective, then we just have to include that in the product cost. So it's just directly product cost. G, salary of corporate legal counsel. That sounds pretty corporate to me, home office type stuff. So that would be a period cost. Letter H, travel expense for your sales force. Again, that has nothing to do with making the product, it has everything to do with selling it. So that would go into your period cost. Wages of plant maintenance personnel. I'm guessing everybody would see that one and think that's a product cost. Now, they're not directly making our farm machinery, but having maintenance personnel is vitally important to make sure that our machinery is well maintained and in working order. Without them, our machinery wouldn't work, so we need them. Wages of production workers, that's direct labor, clearly a product cost. And then workers' comp insurance. Now that one again, I'm not sure if the insurance company would give us a different rate for people in the home office versus production people, because production people would most likely have a higher rate than the folks in our sales force or accounting area or purchasing, HR. Anybody in the corporate office, doing an office job would not have the same premium as somebody doing a production job. So most likely we would have a separate bill. And we'd be able to know exactly what workers' comp is for production folks versus the corporate folks. If not, we could maybe use salaries or something like that as a way to allocate. So there's other ways to do it. Headcount may not be the best one, just because the production folks have a higher rate. But if you went on salaries, maybe. So that's one thought. Again, with allocations, I think everybody knows at this point of your career, there's really no right or wrong. What you're looking for is correlation. You're just looking for some allocation that makes sense, that drives cost. And if you have that, then you're usually in pretty good shape. Okay, the next one is question 3. Okay, oops, I didn't mean to click on the bookmark. I don't use the ebook, and it shows I've got the actual book. So I think my lack of experience using the ebook is showing dramatically. So the next one is question 3, and question 3 is a little bit longer. Now we're going to use FIFO, LIFO, and average. And it says Jessica's office supplies had 300 calculators on hand on January 1 of 17. They cost $16 each. Purchases and sales of calculators during the month of January were as follows. So I've got 2 purchases here on the 14th and 29th. I sold 2 different batches on the 12th and the 30th. They do not maintain perpetual inventory records, right? So they that's using periodic then. And according to a physical count, there was 200 calculators left over at the end of the month. So now the question is, what is ending inventory and cost of goods sold for FIFO, LIFO, and average cost? So all three. So this is kind of the base data. They start out with having 300 for 16. Okay, and everybody should notice, usually when you get a problem like this, what they typically do is every time you buy more, they usually increase the price on you. So you go from 16 to 17 to 18. And then as we sell them, we're selling it for different prices. So this batch was sold at 25, this batch is sold at 30. Don't know why it's different. Possibly if somebody buys a certain quantity, we reduce the price, something like that. Okay. But anyway, so that's the data to look at. And so let's just kind of build a table back in Excel here, and we'll just go with the beginning amount. Let me put that right here. So we've got the beginning, and then we're going to add in the purchases first. We've got the two purchases. I'm just going to say purchase for 14, that's January 14th, and purchase for 29, January 29, and then available is what I'll call this one. So we're going to have to do this kind of both in units. So we'll do beginning units was 300. Then we bought 150, we bought 100, and then the sum of that ends up to be 550. That was available for purchase. Basically, the cost of goods available for sale in quantity was that amount. So the beginning amount was $16, and then we bought the $17 batch and $18 batch, and then we can just multiply across. Whoops, I got to do my math correctly. That would be very helpful. Okay, so plus 300 times 16, there we go. So this is what all that is worth. And let me format this so it looks a little bit better. Okay, so my cost of goods available is $9,150 in dollars, and in units it's 550. Okay, so physical count we know yielded 200 left over, so my ending, and the problem said there's 200 left over, so let's do minus 200, and then everybody should be able to see that 550 plus the 200 is my ending count of 350. Or that's not my ending count, that was what was sold. I sold 350. Okay, so my ending count was 200, which means I sold 350. And that works when you go back to the problem. We have the two batches of sales here, 200 here and 150 here. So the first question then is, let's do this under FIFO, and we know we've got 200 units left over, and we also know that we sold the 350 units, and FIFO first in, first out. I'm assuming that the oldest goods are sold first, so I'm going to go and assume that under FIFO, the oldest goods were sold first, and what's left over is the most recently acquired goods. So what would be left over then is the last two batches, basically the $100 at 18, and or the 100 items at 18, and the 100 to 150 at 17 is what's left over. So let's do the FIFO, and I think I'll just move over to the right and do that. Okay, so there's our base information right there. And let's do the FIFO. I've got 200 units left over, right? So I've got 100 and 100. This is in units, and I go to the last batches here. I just kind of go backwards. I know I've got 200 left over because I counted, so that means I have 100 of these and 100 of the 150 of those. And so this is 18, this is 17. So 18 and the 17, and do the math. Obviously, that's easy math to do. 1,700, 1,800, add that up, and that is my ending inventory. That's my ending inventory, 35. That's what it's worth in dollars. My ending inventory in dollars is 3,500. And then my cost of goods sold, kind of think how we'd calculate that. There's a couple ways to do it, but this is the periodic method. And so under periodic, what I do is I start out with my cost of goods available for sale, COGAS, and that's this number here, the 9,150. and then I subtract the ending inventory. Okay, and we all know that's the 3,500. We just got done doing that number. And so the sum of the two is my cost of goods sold. SIGs, not SIGs, cost of goods sold. Add that up, and we get 5,650. So that is my new ending answer right there. So essentially the two things we're wanting to compute was ending inventory value and my cost of goods sold. So that's how we did that for FIFO. For LIFO, obviously we flip it around. We go kind of the opposite direction, and I'm always assuming the most recently acquired goods in LIFO are sold first, so what's left over would be the beginning. So remember, I sold 350 units. Well, that's the 100 of these, 150 of those, and 100 of the beginning. Okay, so let's do the same analysis for LIFO, and I'll do that. I have to run out of room. Let's make it smaller so we can fit more in here. Okay, let's do LIFO next. We'll do it right here. I'll move this over here. Okay, so let's do LIFO. And so my ending inventory is pretty simple. It is just simply the 200 at the beginning, because I worked backwards, right? So I sold 100 of these, I sold 150 of these. That's 250 out of 350. That means 100 of these have to go of the beginnings. So that means my ending inventory is the actually 200 of the beginnings. So 200, and then those are worth 16. So I'm going to copy paste my formula and go, that would be worth $3,200. So that is the value of my ending inventory using LIFO. So now let's do the cost of goods sold piece, and kind of the same situation. I go with what's my cost of goods available. So I'm going to copy this over. Actually, we should just copy the whole thing over and just put that right over here. Okay. And we know that the cost of goods available is the same amount. It's the 9,150. Okay. I do less my ending inventory, the 3,200, and now I get 5,950. 5,950 as my answer. Okay. And then so that was FIFO, that was LIFO. Now let's do the weighted average. Let me just scoot down here, and we'll do weighted. And weighted's easy. You know, that's, you don't have to worry about assumptions of going forwards or backwards or anything like that. So I kind of actually personally kind of prefer it. And well, all we have to do is go up here and go, I've got 9,150 and in dollars, and that's 550 units. So my average cost per unit is the cost of 9,150 divided by the units of 550. I get 1664. Okay, and then to compute ending inventory, so ending inventory, I should just spell that out for you. Ending inventory is we have 200 left over, right? We all know that, times that amount, the 1664. So that's 3,327. And then my cost of goods sold, again, pretty simple. It's the fact that I sold 350 units times the 1664, and we get 5822. Possibly, you know, Cengage McGraw-Hill would want you to enter that as a whole dollar. So, you know, just when you're doing the actual homework, it tells you what to do. So if it's in whole dollars, it's 5823. Okay, so that was a summary of the three methods. I know everybody would have done that both in principles and intermediate, but I never want to assume you know how to do that. And you get a few questions that'll deal with that in your homework. The next one is cost of goods sold, and that's question 9.4. And right here it says, and this is kind of along the same lines of what we've been doing, the following information for Day Company. You can see that they're giving us quite a bit of info here. Cash disbursements to buy inventory, increase in receivables, decrease in inventory. What is cost of goods sold? So we're going to go back to that T account that I built up here. I can make that a little bigger now. Let me kind of get rid of some of the original information. And we're going to use the same T account for inventory. I've got my beginning number, which they did not give us, so I'm going to put an X right there. We need to solve for that. Everybody kind of see they never gave us beginning inventory. All they said is that inventory decreased by 10,000. So all that I know is that the ending amount is 10,000 less than the beginning amount. I do know that, but I don't know for sure how much. They told us in the question that we spent $290 to buy inventory, and that the increase in payables increased by 25. So kind of the key to this question is that you can kind of identify that I wrote checks for $290,000 to buy inventory, and my payables, because they went up by 25, the sum of those two numbers is actually my purchases. 290 plus 25 is 315, and that's the amount of my purchases for the year. So my purchases are 315. And actually, let me just type that in as the cash amount of 290 plus the increase in AP of 25. Okay, so it's those two numbers together is the 315. And we need to solve for the cost of goods sold. That's really what the question is about. And then ending inventory, it's basically X, it's plus X minus $10,000. Well, I was going to say I didn't format that quite correctly. There we go. So it's basically X minus $10,000. And I should actually just take the plus sign out of there. So X minus 10,000. Okay. All I know for sure is that inventory decreased by $10,000. And so the question then is, what is the cost of goods sold? So basically, because this is 315 and this is lower by 10,000, you can probably visualize, oh, well, 315 minus 10, oh, if I add these together, I get 325. So 315 plus that $10,000 decrease gives me 325. If I have the right amount of zeros, that would be very helpful. 325. Okay, so my answer is this. This is what the question wanted us to compute, was the amount of cost of goods sold. So you can see right there, it's 325, and basically I just had to take the 315, add the 10,000, that gives me 325, and then basically it works. Okay, so that was 9-4, and then 9-5 is we're going to do something kind of similar. So go back to the homework here, and 9-5. For this one, Dumas Company's gross profit was 96. Cost of goods manufactured was 340. Beginning inventory of goods in process and finished goods is 28 and 45. Ending inventory of goods in process and finished goods is 38. And 52, what is the dollar amount of sales in 17? Dollar amount of sales in 17. So we're going to use the T account again. Let me get rid of this stuff here. That should go away. Actually, let's do like this. Okay. And instead of this being inventory, it's finished goods. Okay. So then we have our beginning balance, just like we always have. So beginning balance. And let's think of what all those numbers were again. So finished goods, it says ending inventories of goods in process and finished goods, 38 and 52. And the beginning amount was right here, 45. So finished goods beginning 45, finished goods ending was 52. And then the ending balance, we'll put that down here, was 52. Okay. Now, they also gave us cost of goods manufactured. They said 340,000. So COGM, cost of goods manufactured, 340. Okay. And the question is to solve for cost of goods sold. Okay, so basically I have to solve for this amount right here. I hit the wrong amount. Okay, let's solve for that. So to solve for cost of goods sold, obviously it shouldn't be that too terribly hard to figure out what that is, because I can kind of back into it now, right? And think about what finished goods means for a manufacturer, right? They're making the goods that they then sell to somebody else. The beginning balance is 45. It cost us $340,000 to make new goods, and then credits to finished goods represent cost of goods sold to our customers, and we end up at 52. So if you go ahead and just kind of think through, well, I can take the 45 plus the 340 minus the 52, and that will get us there. Okay, so that'll be 333 is my answer. So again, plus 45 plus 340 minus 52 is my 333. Now the other part of the question is, what is sales for the year? And that's really what the ultimate answer is. But you have to compute what the cost of goods sold is to do that. And then it says here, gross profit was 96. Aha, that's the answer, right? So my cost of goods sold of 333. Okay, so let's just go ahead and put that over here. So cost of goods sold, and then my gross profit. So the 333. My gross profit 96. The sum of the two is my sales. So sales is 429. Okay, that's my sales number. So that's really the ultimate answer right there. Sales is 429. Okay, then we'll do one more, and this one deals with manufacturing. This is question 7. And for this one, it says compute the work in process inventory from balance sheet income statement information. June 30th, 17, tornado damages Jensen Company's warehouse and factory, completely destroying the work in process inventory. Neither raw materials or finished goods were damaged. A physical inventory taken after the tornado reveals the following valuations. So raw materials worth 87, work in process is a goner, finished goods are 151, and then inventory as of January 1 of 17 is so this is the ending balances right here. These are the beginning balances: 41, 128, and 173. Review of the books. And records discloses gross profit is historically 28%. That's important. The sales for the first 6 months was 405. Raw materials purchased was 150. Direct labor costs for the period were 112. And manufacturing overhead has been 50% of direct labor. What is work in process? Okay. So remember, for manufacturers, they really have 3 inventory accounts. They have raw materials, work in process, and then finished goods. So it's kind of the combination of the 3 that we have to worry about. So we have to solve for all of them, and ultimately we're trying to figure out what is the ending work in process amount. So I'm going to just kind of start from scratch and just get a new area down here. And let's go ahead and figure out my balances for my 3 accounts. So that's really what we have to do, and to ultimately solve for the work in process. So we do beginning raw materials, beginning RM, plus purchases, and then we get down to the ending amount, ending raw materials. Okay, so let's just go ahead and do a T account here. That will do that one for us. And we'll kind of just copy this one over a little bit. Okay, so beginning given to us was 41,000. And let me format these two. I like them formatted better. Okay, and then they told us that we bought 150. Okay, and we know the ending balance is 87. That was given to us. Okay, so all these things right here were given to us. So that leaves what was transferred out. Remember how goods flow in a factory. They start out in raw materials as we buy them. then we transfer them to work in process. So RM transferred to WIP. That's basically the credit. So this is what we're solving for. Raw materials transferred to work in process. So again, you can just take plus 41 plus 150 minus 87, and that gets you to the answer. It's, okay, 104. So 104,000 is transferred. So you need to solve that one. Okay, let's do kind of the same thing then. We'll copy and paste this one over. Okay, instead of raw materials, now we'll do finished goods. So FG for finished goods. So that's my beginning finished goods, and then my ending finished goods. Okay, so my beginning number was given to us. It was 173. We don't have purchases, so that really wouldn't be something that we would include in that. Instead, we'd have cost of goods manufactured would be the debit, and then we credit cost of goods sold. So as we sell a finished good to our customer, we credit that number. So my beginning finished good is 173. My ending finished good was 151. And what they did is actually they gave us the cost of goods sold amount. They gave us, and we can figure out, actually they didn't give it to us per se, but we can figure it out because they gave us the sales number and they gave us the markup. And that's what we need to know to figure out what cost of goods sold is. So remember that the gross profit margin is 28% and sales were 405. Okay. So if gross profit is 28, that means that the cost of goods sold are 0.72. So what I can do is I can take my sales number. Let me just do that down here. So let's take the sales, and that was at 405. And then I take my cost of goods sold percent, and that was 1 minus the gross profit percent, and that was 0.28. So that gives me 0.72. So I take 405 times 0.72, I get 291.6. So my cost of goods sold is 291,600. And of course, we could double check the math. So, and then that leaves cost of goods manufactured as to solve for, basically. So, that would be kind of the last piece is, so I've got that figured out. I don't know what cost of goods manufactured is, but I can easily solve for that to come up with the answer. And that would be, it'll be 269.6. I just got to think about how the math works. So it'll be a plus here, a plus here, and a minus here. Let's see if I got that right. I did not. So let's see. It would be plus this, plus. There we go. I got it right that time. So I did plus the ending, plus the cost of goods sold minus the beginning. And that gave me the answer of 2696. Okay, so plus ending, plus cost of goods sold minus beginning. 269.6. So I just solved for that one too. So I can just solve for two different things here to get to the right answer. So now that we've got those, we can kind of back into work in process. And let me, I like to get this all on one little section, so I'm going to move this stuff over. Okay, so let's go ahead and do that right here. I'm just going to copy and paste this over. Okay. And so this is WIP. And let me get rid of these numbers. And get rid of those. Okay. So kind of the same story. We've got a beginning number. They gave it to us. They said your beginning WIP is 128. And we know that we added several things to that throughout the year, or the 6 months. We're looking at a 6-month time period. And you can see what those are. So we have direct labor here of 112. We'll transfer in the raw materials out of, we'll come back to that. We also have to calculate overhead, They said overhead is 50% of direct labor, okay, which is 50% times the 112. Okay, so let's go ahead and do that. So direct material, we computed that one. That is the number right here. So the credit to raw material is then a debit to work in process. And then we have the direct labor. They just gave us that number and said it's 112. And then overhead, MOH, manufacturing overhead, is 50% of direct labor. So that times 0.5. We get that answer. And then, of course, out of WIP, we subtract cost of goods manufactured. So right here is the cost of goods manufactured. Okay, right there. So COGM, cost of goods manufactured, and then that gives us the ending balance. Okay. And that's what, they said it's 0 because it didn't exist anymore, but this is how I'd be able to calculate my ending balance is, clearly I just do the debits or adds, and then the credit is a subtract, and my ending inventory balance in WIP is the 130,400. And the reason that's important, of course, is I'm going to be filing an insurance claim, right? So, because that work in process is gone, and we think has a value of 130,400, and I need to calculate a claim. And so this is the kind of calculation I would show my insurance company to say, here's what we figured out our ending inventory balance was worth. Okay, and I should also mention one more question, question 15. Let me get back to the homework here. So question 15. And with 15, the big takeaway is I want everybody to kind of remember how inventory errors work, that they self-correct after 2 years. That's kind of the key here. And so you can see that the following inventory valuation errors have been discovered for Knox. We've got 3 different years with errors, and then here was their income in each of the 3 years, and they want us to kind of go through and figure out what was the income, and doing this all pre-tax, that we should have been using to correct these errors. So we'll kind of do 1 year, and then I think you'll kind of see how that works from there. So you can see that in 2015, it was 38, but let's look at 2015. Year-end inventory was overstated by $23,000. So when something is ending inventory is overstated, we have to think through how does that impact ultimately cost of goods sold. So I'm just going to show you a little bit of kind of a format you can follow to figure that out. So the 2015 error is we kind of follow this pattern right here. So beginning inventory plus purchases equals what we call the cost of goods available for sale, COGAS, less ending inventory equals cost of goods sold. Okay, so that's kind of how you have to think these through. And in 15, we just know they gave us one thing. They said ending inventory was overstated by $23,000. Okay, so ending was overstated. So basically my beginning was okay. I'm just going to put in a 0. My purchases are fine. That means this is fine because this is just the sum of these two. Okay, my ending was overstated by 23,000. Okay, so this minus this equals my cost of goods sold, and it was too low by 23,000. So think about that. If ending inventory is too high by 23, cost of goods sold is too low by 23. Okay, because I really did sell those goods. That 23,000 that was overstated, well, that was really sold, and so my cost of goods sold is too low, and I need to increase it. So my cost of goods sold will increase it. It'll go up. It'll go higher, meaning that the income they gave us of 138 was too high. So I take 138 minus 23, and I get 115. Okay, so that's kind of the process you have to go through to figure that out. So just kind of think that through as you work through a question, any questions like that. Okay. Hopefully it all made sense. If you got questions, just let me know. I'll be more than happy to go over them with you in the class or through email. You can stop and see me, assuming we have classes again someday. Just kind of joking. But hopefully it all made sense. Thanks.